Hi, everybody. I'm Lou Chain with the Hearth team. This is Joey Kearns, my business partner, and we're here with Julee Felsman from Guaranteed Rate Mortgage. And we want to talk about a 2-1 buy down program that her company offers. That is a really just kind of a nice option for buyers in this market when interest rates are, pretty high, higher than they've been in a few years. So,
100%. Yeah.
yeah. So Julie, we're just going to have you start by just kind of explaining what that program is.
So when we talk about buy downs, there are really two types of interest rate buy downs. There are temporary and permanent interest rate buy downs. And a 2-1 buy down is a temporary interest rate buy down. So it's a boring old fixed rate mortgage. Your rate is going to be fixed in at today's 30-year fixed rates, which we sure wish were lower than they are. One of the reasons these buy downs are kind of nice. And a 2-1 buy down discounts your interest rate and therefore your monthly payment by 2% from whatever your locked in 30-year fixed rate is for the first 12 monthly payments, and then by 1% from whatever your locked in 30-year fixed rate loan is for the next 12 payments. So for the first 24 months, you're paying a lower monthly payment and based on a lower interest rate than that 30-year fixed rate that you have locked in.
Okay. So that is, yes, makes perfect sense. I'm curious about the cost of a temporary buy down versus a permanent buy down. Can you talk a little bit about that?
Yeah, for sure. The cost of a temporary interest rate buy down is exactly to the penny the amount that you're not paying at the discounted monthly payment over those initial 2 years. And this cost is something that the seller pays on your behalf. So it's a way for a seller in this market where it's possible, there are up and downsides to this market. One of the upsides is it's possible to get sellers to pay a concession. And this is a wonderful way to spend some of the seller's money to buy you a break on your monthly payment for the first couple of years. And that cost is, defined and to the penny at closing. The seller deposits that money with your lender. Your lender holds that money on account. And when you're writing that lower monthly check, the difference between your real monthly payment at your actual interest rate and the smaller check that you're writing for those first 2 years gets paid out of what is really a subsidy fund set up by the seller. And so it kind of closes the gap for the first 12 months. That gap is, based on the 2%. For the next 12 months is based on 1%. And then the subsidy fund runs out. And at that point, you start with month 25, your 25th payment, paying what your full monthly payment would be at the fixed rate that you had locked in. Now, permanent interest rate buy downs are by nature different. You're paying something called discount points at closing, and this can be paid with your money or the seller's, unlike a temporary interest rate buy down where the seller picks up the tab for that, you don't. With a permanent interest rate buy down, you can spend a seller concession to buy your interest rate down permanently, or you can spend some of your own money to buy the interest rate down permanently. And the amount varies quite a bit, actually. It can vary quite a bit from one day to another, from one rate to another. If you pressed me to give you kind of a rule of thumb, I would say roughly every 0.4% of your loan amount that you pay upfront, an extra for $100,000 of loan amount, $400 upfront, would buy a reduction in your interest rate of about 0.125%. That can vary all over the place, though. That's definitely not like a formula you want to write home about. But then your interest rate is permanently cheaper. I would say if you're a little bit of a pessimist with regard to where you think interest rates are headed, if you think the higher interest rates that we're seeing today are something that's here to stay, then permanently buying your interest rate down could make sense, right? You're going to save money for potentially, especially if you're going to stay in a home for a lot of years, like many years at that lower interest rate. If you're feeling a little more optimistic that at some point in the not too distant future, interest rates are going to be lower and you might have an opportunity to refinance and reduce your interest rate, refinance into a new mortgage at a lower rate, then the temporary interest rate buy down is a way to kind of tide yourself over, right? Buy yourself a little bit of breathing room between now and that opportunity in the future when you hope you're going to be able to refinance your interest rate and reduce the payment.
Totally. And actually, so that brings up my next question. if you decide to refinance in like 18 months, say the interest rates are, back down to where we've kind of been seeing them, there's
Yeah.
a refund that comes back to you. Can you tell us about that?
Yeah, if you there's a difference actually between the permanent and the temporary interest rate buy down. So if you paid points and you bought yourself a lower interest rate, that's done. It's water under the bridge, and at no point in the future are you going to get a refund of any of that money. You're hopefully going to be saving back at least or more than that amount of money over time in a reduced interest rate and a reduced monthly payment. But it is, it's not money you're going to see back. So if rates fall in 18 months in your example and you're refinancing, either you recaptured that money that you paid at closing or you didn't. But at that point, it's, fait accompli. That's totally different with the temporary interest rate buy down. There's a subsidy fund. The seller's money was deposited with your lender, like we talked about before, and that's on account. And if you haven't spent all of it, if you haven't gone all the way through the 24 months of discount, then that money's sitting there. And when your lender gets the request to pay off the mortgage, you're refinancing, you want to pay off that existing loan with a new one, they'll apply the remaining funds in that account as a credit toward the balance on your mortgage, reduce the principal balance that you're paying off. And really, because as you refinance, you'll be paying closing costs, you're kind of getting a nice little offset there. Part of that seller's money that you didn't spend on a discounted monthly payment can be credited to offset some of the costs for setting up that new mortgage and refinancing.
Great. So it could be, in a lot of ways, it could be a benefit for both the seller and the buyer. If the seller's looking at a price reduction, this might be a better option to just do a temporary buy down for the buyer. They're actually going to, net more money doing that than they would doing a price reduction, and maybe everybody wins.
Yeah, I mean, the bang for your buck that you get, if you're looking at a seller that's willing to concede some money, and as a buyer, you're thinking, okay, well, the seller would be willing to reduce the price. The seller might be willing to credit some money toward my closing costs, like, a seller paying a concession to pay for a whole bunch of things for you. For the short term, again, if you're feeling optimistic that maybe interest rates are going to be lower and you're going to be refinancing and you're looking for a way to kind of, minimize the impact of this big quick run up in interest rates that we've had for the short term while you bide your time, then, you have this really significant difference in what your monthly payment is going to be using a temporary interest rate buy down. You get a little bit less, a good bang for your buck, but a little bit less dramatic bang for your buck if you pay discount points. But again, you're running the risk that maybe you won't recapture all of that if you do have the opportunity to refinance. If you take it as a credit towards your closing costs, that reduces how much money you have due at closing, but it doesn't change your monthly payment, right? That's just less cash out of pocket at closing, offsetting costs you would have paid if the seller hadn't paid them for you. If you reduce your price, it doesn't make a huge difference. I think sometimes folks think, I lower my price, I'm going to see a way lower monthly payment. Well, right now, every $1,000 that you put down on a mortgage is going to make a difference of maybe $6.50 to $6.80 a month, somewhere in that neighborhood. So if you had a seller paying $10,000 towards your, or reducing the price $10,000, you may only see like a, $65, $70 difference in your monthly payment, just not anything too dramatic. Where these buy downs, temporary interest rate buy down, will probably be hundreds of dollars a month discount in your monthly payment, multiple hundreds of dollars over that first few years.
Well, that is really super good to have explained. Thank you so much. I think with the way buyers have been beat up in the last couple of years in this market, it just is I feel like a lot of people are just, shy of purchasing right now. But the fact is you're going to have a much easier time getting a house in this moment than you would have a year ago, or, certainly last spring.
There were a lot of things that, despite the very low interest rate you could get, last year, were not so great for buyers, like a long list of things that I think, weren't as much fun for buyers. So being in a market now where buyers do have to hold their nose a little bit as we close, and you're paying these interest rates that are higher. And we've talked a little bit about the possibility of refinancing, but needless to say, there is no guarantee. Nobody knows where interest rates are going or what's going to happen in the future. I believe they're likely to come down in probably an 18 to 24 month window personally, but I don't have a crystal ball and I can't promise that. And so you've got to budget off of that worst case monthly payment. I think folks who are a really good fit for a 2-1 buy down to me are if you have a fairly regular increase to your income. I had a couple clients I spoke with recently who are both educators. They're union, they have contracts that dictate a certain increase to their pay that they're going to get every year. So their confidence that they can afford that higher monthly payment if they don't get the opportunity to refinance is really high. We as lenders have to qualify our clients at that true 30-year fixed rate. You know, the discount's nice, but the fixed rate, that it is a 30-year fixed rate loan at today's rates. And so we have to use today's rates to qualify our clients. And, you know, I recommend everybody thinking about a temporary interest rate buy down, budget for that higher monthly payment that you know is coming down the road. If you don't have, you know, watch, cross your fingers, hope you can refinance, but budget, plan around the higher monthly payment. And it is worth mentioning that we have a couple other flavors of the buy down as well. We could do a 1.5 buy down, so not quite as much a discount each time. And we also have a 1.0 buy down, just buys the interest rate down by 1% for the first 12 payments, and then you're at your full monthly payment and interest rate the next year. Obviously, as you go from the 2.1 to the 1.5 to the 1.0, the cost the seller has to pay is a little bit less because the discount on the interest rate is a little bit less. So you can find a version of that that kind of calibrates with what the seller is willing to pay on behalf of the buyer.
Yeah, do a little negotiating there.
Yep, that's where you guys come in.
Yep.
You get to work your magic and negotiate in this market on behalf of your buyers.
Well, Julie, this is actually really great information. I appreciate you going through all of this. I was wondering if you could give us some like finite numbers. Let's do something around like on a $500,000 home. And let's say the seller, we do a 1.5 and then a 0.5 the following year. What would that cost the seller and what would that save the buyer?
Great question.
So it's actually based on the loan amount, not the purchase price. So we've got to talk about how much folks are borrowing. But in rough numbers, the 2.1 buy down is going to be about 2.3% of the loan amount. So if we say that's a $500,000 mortgage, then we're talking about an $11,500 cost-ish, give or take, on a $500,000 mortgage. On a 0.5 or on a 1.5, it's going to be around 1.8% of the loan amount. And I'm just poking at a calculator because I'm not going to do that math in my head. So about $9,000-ish would be the cost of that. And then the 1.0 buy down is generally going to be about 0.8% of the loan amount. So on a $500,000 loan amount, the 0.8 is going to be right around $4,000 cost for that 1.0 buy down. And those numbers change a little bit depending on what the interest rate is, but that's a ballpark. And I mean, I would actually throw the question to you guys: is $4,000, $9,000, $11,000, $12,000 on, you know, something where someone's borrowing $500,000? Are those realistic concessions based on what you're seeing in the market right now? Are those things you feel like you're able to negotiate for your clients?
I think it depends on the house. It depends on how competitive it is. You know, if it's been on the market for a minute, then we might be able to do that. So it really, so, you know, like you have these concrete numbers you can work with. For us, it's like, it's always, what is this house? How many people are after it?
A little fuzzier.
Yeah, it's a little bit fuzzier. Awesome. Well, I really appreciate your time. This has been super helpful, and we'll post this on all of our socials.
It's been totally a pleasure. Yeah, my pleasure. Thanks, you too.
Awesome. All right. Well, we'll see you soon, Julie. Thank you so much.
You're welcome. Thank you.